Yo, welcome back to the channel. Listen, I've been receiving many questions about all different aspects of the stock market, but when I start to notice a trend, I feel that actually, you know what, it might be useful to make a video about that, because there could be many more people that haven't asked me the question that might be actually wanting to know the answer as well. So one trend I am noticing is the topic of cutting dividends, and with everything that's going on in the market right now, more companies are opting to do this. So here I'll give a brief overview as to who's doing it, why they're doing it, and my response to that. But first, I'm going to touch on the topic of dividend aristocrats, because if you are new to the market and you are a dividend investor, then it may prove to be something that's going to be important and useful to you. So if you want to know all of that and more, please like, comment, subscribe, help the channel get to 5k. We can get the world of investing out to more people. So let's start with dividend aristocrats. Basically, a dividend aristocrat is simple. It's a list of companies that have been able to steadily increase their dividends for the past 25 years. So I'm on dividend.com right now, which is one of the resources I like to go to for anything dividend related. And here you can see a list of companies that have steadily increased their dividend payment over the last 25 years. So just to not confuse anyone, if anyone might be wondering, I'm not referring to the dividend yield, I'm referring to the dividend payment. So if, for example, I've got Google up. Let's go to, I just want to give a quick example just to make sure that everyone is on the same page with what I'm actually referring to. So if we pick a stock, I'm going to go with Legal and General. Let's pick Legal and General. And this is basically going to be, on London Stock Exchange, and you can basically see the balance sheet. I've gone through all of this in the dividend video, so I'll leave the link in the description for that. But here you'll be able to see their balance sheet, and what you can see is this line item here called dividend per share, and this is effectively the annual dividend that they pay to you per year per dividend that you per share that you actually hold within that company. So within the context of Legal and General, what you can see 2014, 15 up to 2018, you can see that they were paying 9.23p for every share that you held in Legal and General for that year. Then it increased to 11.3p, 13.202p, 15.35p, and 16.42p. So again, just to be clear, this is not £9.23, this is 9.23 pence per share. And obviously the share price was, something around, I don't know, £2 or something like that. So you can then basically work out the yield from that standpoint there. So a dividend aristocrat is a company that's effectively continuing to do this and increase their dividend payment on a yearly basis for 25 years. And basically this is a list of companies that do that. So I know a lot of you talk about some of these companies from 3M, Procter and Gamble, Coca-Cola. These are companies that ABM, there are companies that are often cited as really good dividend paying stocks and companies that you should potentially always hold, because obviously they continue to increase their dividend. Now that's obviously if you are a dividend investor. However, a lot of companies pay dividends. I don't know what the percentage of all stock companies that pay dividends, but many companies pay dividends, and a lot of them aren't going to be a dividend aristocrat. And what's happening now is that you're finding that a lot of companies are choosing to cut their dividend because of the whole coronavirus situation. So some of you guys are asking, why is companies cutting their dividends, etc., etc. So I've got this link which I'll leave in the description from Investopedia. Why would a company drastically cut its dividend? This is probably more broad, but I think actually a lot of the information here is going to be relevant to what's going on at this current time. So I'm going to read through some of the sections and then basically give you my thoughts and opinions. So why would a company drastically cut its dividend? A portion of a company's net profit can be allocated to shareholders as a dividend or kept within the company as retained earnings. Dividend payments are decided by the board of directors and must be approved by shareholders. These payments can be issued as cash or as shares of stock. Typically, we're not seeing much companies do share of stock dividend payments. It's typically cash, but obviously that might change at some stage in the future. A dividend cut occurs when a dividend paying company either completely stops paying its dividend, which is usually a worst case scenario, or reduces the amount it pays out, which is the scenario that's happening at the moment across the board with many stocks. Not all stocks, but many stocks. Now this most often leads to a sharp decline in the company's stock price, because this action is usually a sign of a company's weakening financial position, which makes the company less attractive to investors. So if everything is all rosy daisy in the market and then a company spikes up out of the blue and says, hey guys, we are going to cut our dividend, then typically it's seen as a negative thing, because why, if everything is meant to be okay with the company, would you stop paying your dividend, or severely reduce the dividend you're paying to investors, who's actually obviously helped the company by investing their hard-earned money into the company? So understanding why dividends may be cut. Most often bad news. Dividends are cut due to factors such as weakening earnings or limited funds available to meet the dividend payment. Now, that for me is pretty much the reason of what's happening at the moment. With everything that's going on, there's going to be a lot of revenue decline, a lot of top line decline in wealth for many organizations. And because of that, they are going to be looking at ways that they can cut, ways that they can optimize their balance sheet, so that obviously, they can continue to operations. They don't have to maybe get rid of so many staff, etc., etc. And so one of the first things that they're probably going to look at is obviously the amount they pay to investors. They're not going to want to completely piss off investors, but ultimately they've got a business that they're going to have to keep on running. Think of it like yourself. If you, for whatever reason, you're having a salary, you've got a job, and for whatever reason you lose your job, as an example, typically you're going to start to look at how can you manage your money. What things are you going to have to cut in your life in order to continue operating as normal? I remember when I used to work in a bank and people would lose their jobs and they would come to me and we would basically do a financial review and look through all of their direct debits, look through all of their payments, their standing orders on a monthly basis, and literally go through them one by one and basically saying, what is this? What do you use it for? When was the last time you used this product or service? Is it actually valuable to you? Can you basically cut this, etc., etc.? And you'd find that there'll be so many things that can basically be cut, from, I don't know, gym memberships, or maybe little Teresa's tennis lessons, or Gareth's guitar lessons, whatever it might be. There's going to be things that people can actually cut in times of financial difficulty. I'll tell you one thing, what never gets cut is two things, and that is Sky. No one ever cuts their Sky bill, and no one ever cuts the amount they actually spend on cigarettes. Probably the reason why cigarette stocks actually tend to do well in a recession. Anyway, I digress. That you get the idea that anyone that's managing money, if you have a drop in the amount of income that you actually get, you should obviously be considering what you can actually cut in order to, maintain and grind through that period. What some people do is turn to loans and turn to credit cards as a way to kind of maintain their lifestyle, and that is a behavior that gets people into debt in the future. Anyway, let me not ramble on, and let's get back into dividend cuts. So typically, dividends are paid out from the company's earnings. Earnings is being profit from this. It's not revenues. It's typically earnings. And if earnings decline over time, the company either needs to increase its payout rate or access capital from other places, such as its short-term investments or debt, to meet its past dividend levels. Kind of basically what I mentioned about people doing it. So its payout rate is basically its payout ratio. This is the ratio of which the amount of earnings it makes and how much it actually pays out to shareholders. The sweet spot is considered 35% to 55%. So if a company is paying their payout ratio, say 10%, it's felt that they're actually not paying out as much as they should be to investors, and maybe they're retaining their earnings for CEO bonuses, or something that's maybe it could be growth or reinvesting back into the business, but it also could be a negative reason. If the payout ratio is too high, let's say it's like 90%, then it's actually, can they actually sustain that on a yearly and a growing basis? Maybe they're paying out too much from what they've got. You will find instances where actually they're paying out more than 100%, and that's because they're actually drawing on debt or liquidating certain things in order to maintain the appearance that they're able to meet their dividend commitments, because it's a really big PR and selling point to so many companies. So different companies will behave in different ways depending on obviously the situation that they're in, but ultimately they might need to increase their payout rate or access capital from other places, such as short-term investments or debt, to meet the past dividend levels. Now, dividend cuts are most often a negative sign for a company's financial health. Companies usually make drastic dividend cuts because of financial challenges like declining earnings or mounting debts, and sometimes companies may cut dividend payments for a more positive reasons, like preparing for a major acquisition or a stock buyback. So you might have things where companies actually say, what, we need to retain some money because we're going to be doing something really big, like buying another company or buying some of our shares back, which actually would then increase the value of the shares from a capital gain perspective, and that might be a reason. So you always have to understand what is the underlying reasons why someone might do it. For example, let's say, for example, I've got a daughter called Teresa, which I don't, but let's say I do, and she's got tennis lessons. I might be cutting her tennis lessons, not because, you know, I've got financial difficulties, but because, you know, maybe she's whack at tennis and we just need to find her a new hobby, swimming or something. I don't know. But there's always going to be a different reason. Just because the action happens, it doesn't necessarily mean that the action is a bad or good thing. It means that you have to understand why the action is taken. Now, if the company uses money from non-earning sources or takes up too much of the earnings, it may be putting itself into a compromising financial position, which obviously we're seeing that loads of companies are in compromising financial positions anyway. But if they did that in normal times, then obviously it could put them into a bad situation. So for example, if it has no money to pay off its debts because it's paying out too much in dividends, the company could default on its debts. But usually it won't come to this, as dividends are usually near the top of the list of things cut when a company is faced with financial challenges. So this is really important. When a company faces financial challenges, a dividend cut is pretty much at the top of the list of what they're going to do in order to try and retain some of their money. So when you're seeing that a lot of companies are doing this, it's not because maybe a lot of companies are, you know, at ground zero. It's probably because they have a checklist of things that they need to do during, you know, crisis times, and they're basically going through that checklist. And actually the first thing on the checklist is to see how much of their dividend they can cut in order to retain operations. And then it might be staff, and then it might be CEO bonuses, and then it might be operations or selling off assets, or it could be they'll have a systematic flow of activities that they can potentially do. This is exactly why dividend cuts are seen as negative. A cut is a sign that the company is no longer able to pay out the same amount of dividends as it did before without creating further financial difficulties. It's not always bad news. While most investors rightly consider a drastic dividend cut a negative sign for a company's health, on some occasions it is not such a harbinger of doom for a company under certain conditions. For example, when the pricing and conditions are just right for a stock buyback. A lot of companies have been talking about that, well, prior to all of this crisis. Whether in a major recession becomes the priority, or company needs to accumulate cash on hand for a big merger or acquisition. So whether in a major recession becomes the priority, and I think that's also a very, very key point. So actually, in a not always bad news section, you've got whether in a major recession becomes the priority. And for me personally, when I spoke in the previous video that we're kind of in a non-recession recession, we've got all of the symptoms of a recession without the simple technical fact of 2 consecutive quarters. And so because of that, companies might actually be doing this in order to preserve and actually weather this storm so that they can retain operations in the future. So, you know, I'll get into my response into this, you know, in a second, but I think actually that's not really a bad thing in short. In these cases, a dividend cut rather than a drastic one may not necessarily be a sign of trouble, or even a sign that the stock is selling. The sign that selling the stock is your best course of action. Like with any and all financial decisions, doing due diligence and careful research is the successful key to investing. You have to obviously research the individual situations. Now, before I get into my reasons, I'm going to go back to the Dividend Aristocrats. If you are new to the market and you're thinking, you know what, I have to look and research into all of these Dividend Aristocrats in order to actually work out, you know, in order to actually get, you know, stocks that continuously raise their dividend. You don't have to do that. There are going to be ETFs that basically track Dividend Aristocrats. One ETF at the moment is USDV. That's available on free trade, and that's basically an ETF that will basically track, you know, Dividend Aristocrats. And obviously if ones fall out of the 25-year period, then they'll get dropped from the ETF, and if new ones come into the 25-year period or more, then they'll get included into the ETF. So that can be just an easy way for you to invest money into something that's going to steadily, you know, track companies that will steadily increase their dividends. Now, when it comes to whether or not these current dividend stocks or that are cutting their dividends is a bad or good thing, I think it's actually a little bit of a mixed bag. So you can see here, I'm on a Barron's article, which I'll basically share in the description as well, that here are a list of companies that have suspended their dividends and stopped buying back stock as well. And here it basically lists a list of companies, some probably available on your broker, some might not be, depending on, you know, where they're based, and it will tell you that, you know, what they're basically doing with that stock, and actually would they be cutting their dividends, etc., or have they said anything. So as an example, on March 20th, Boeing, ticker symbol BA, said it will suspend its dividend and buybacks as it seeks to conserve cash while requesting government assistance. So in this context, they're suspending their dividend entirely, from what I gather, and obviously we know that Boeing is going to be severely affected situation. Boeing had a lot of issues throughout the course of last year, from what was happening with the 737 Max, also CEOs. They had a lot of issues. And now obviously they're compounded with the whole travel bans and things like that. Is going to have a material impact on the Boeing business. So they're suspending their dividend, and obviously they're requesting government assistance. So I know some of you guys have asked me, would I invest in Boeing? Is Boeing at levels that I would personally invest in? Me personally, just because of the whole climate of the travel industry at the moment, I personally wouldn't. I know obviously it's probably at favorable levels for people that definitely held it before, but for me personally, I'm staying away from travel, which I've basically said on a number of occasions. You've seen the likes of, as an example, Ford Motor is suspending its dividend as it closes its manufacturing operations in North America. Macy's is suspending its dividends following its payout on April the 1st. So there's one payout that they're going to be doing, and then they're going to suspend its dividends. Marriott, obviously a chain of hotels, suspending its dividend. That's a lot of travel related brands that are basically doing it. And you know what, if you believe in the company, I always say this, you have to decide whether you believe in the company, you believe in the business long term. If this is a minor blip in their operations and you believe in it long term, then this could still be an opportunity. But obviously if it's not going to be paying you a dividend and the capital gain is probably going to be crashing for the time being, then maybe some of these stocks are worth holding, maybe not buying or new acquisitions. But obviously you've got to take it on a case by case basis and do your own research. You've got companies like McDonald's suspended its share repurchases, but the CEO said that it would keep paying its dividend, which is obviously a really positive sign. So they're not obviously changing their dividend strategy. They're going to keep paying their dividend as well. So I'll leave this link in the description. But anyway, are dividend cuts a bad thing at the moment? Not necessarily. I think dividend cuts at the moment sound wise to me for companies to potentially be doing that. Ultimately this coronavirus situation is going to be something that's completely it is something that's completely unprecedented, that many businesses probably didn't account for. And so if they want to try and stay afloat and try and keep their operations running as smoothly as possible, then cutting their dividends in order to help maintain that at this current time, for me, makes a lot of sense. It does make a lot of sense, because I wouldn't say it's a luxury, but it is something that can keep their operations running, keep their staff running, and keep things flowing through this difficult period until afterwards, where they can potentially re-increase it again and get back to normal. So yeah, I don't really think it's a negative thing, but I will say if some of the companies that you hold, and obviously I've just mentioned a few, but there's going to be a lot of stocks that are probably cutting their dividends that you would know from the ones that you hold, I would definitely look into the operations of that company. I would definitely try to explore whether or not this is going to severely be a company that's going to be in distressed times, even post-coronavirus situation or post-recession situation. You could potentially look at 2008 recession or previous recessions and previous bear markets to see how they've basically responded in those situations, and then make a judgment from that standpoint. But ultimately, if you believe in the business and you believe long term into them and they're cutting their dividends, then I don't think necessarily it's a bad thing. And if you are making a loss on some of these companies right now, which a lot of you guys might be, then actually continuing to invest into them might be the right thing to do. Me personally, as I've said, because I get asked this question all of the time, I'm definitely storing cash up right now. That's going to be my main priority, and doing a little bit of trading here and there where I can. But yeah, I don't think dividend cuts is necessarily a bad thing. But listen, get in the comments, let me know how you feel about dividend cuts with your specific stocks, and what your actions are, and share any information you've got with other people in the comments as well that might be wanting to know this, and hopefully they'll find this useful as well. If you do, like, comment, subscribe, and I will catch you next time with another investment video. Take care, guys. Peace.